Welcome to the Stock Market Palantir. Today we are going to talk about ECX, Holdings. This stock presents a really fascinating and frankly deeply frustrating case study in the late 2025 auto tech market. We're seeing this massive disconnect, which we're calling the investment paradox. You have corporate fundamentals hitting a historic high, yet the stock price, well, it continues to suggest structural failure.
And that divergence is exactly why this is such a contentious stock. I mean, if we just look at the technical reality, the stock is completely locked. It's entrenched in that $1.70 to $2 range as of, December 2025. You look at the charts, volatility is incredibly high. It's trading drastically below its initial listing price. And you have that clear negative configuration known as a death cross.
Okay, so for listeners who maybe aren't glued to their charts all day, what exactly does a death cross signal in terms of market confidence, especially with that long-term resistance sitting so stubbornly at 214?
It signals pervasive skepticism. You've got the 50-day moving average crossing below the 200-day moving average. It means that the short-term selling pressure is just completely overwhelming the long-term trend. This isn't just apathy. This is the market treating ECX as fundamentally damaged, almost regardless of what the earnings report claims.
But that's where I think we have to look beyond just the simple charts and address the mechanical noise. The structural signals strongly suggest that there are outside forces at work here. We're talking about abnormally high off-exchange short volume ratios. The ratio hit an astounding 41.95% on November 26th. And critically, we saw that massive fails to deliver, that FTD spike of over 1.2 million shares right after the Q3 earnings on November 4th.
See, that high short volume and the FTD spike, they aren't noise. They are the symptoms of the underlying problem we need to talk about. The pressure is structural, sure, but it is not accidental.
So, okay, this is the central disagreement we need to frame then. Is the market's refusal to reward ECX primarily because its positive fundamental performance is just being neutralized by a sector-wide bias and some transient market issues? Or is the stock fundamentally paralyzed by a toxic capital structure and mechanical short-selling pressure that's simply too powerful for any good news to overcome?
I'd come at it from a different way. I would argue that the price action is driven almost entirely by the inescapable and powerful dilution risks that are embedded in that recent convertible debt financing. That structural overhang is the primary force, and it's just drowning out any positive news from the P&L statement.
And I believe the Q3 2025 fundamental inflection point, that historic, hard-won net profit of $0.9 million, signals genuine foundational value. I see the current depressed price as, a temporary suppression caused by this systemic bias against former SPACs, compounded by the very structural issues you're highlighting. The business model, I think, has been proven viable.
Well, let's delve into the quality of that profitability then.
All right. ECX achieved a historic milestone. They reported their first quarterly net profit of $0.9 million and adjusted EBITDA of $8.3 million for Q3 2025. This move pulls the company out of that dreaded cash burn category. And I don't think this is a one-off event either.
It might be a one-off accounting achievement.
I have to disagree. This is sustainable profit. It's driven by intelligent cost rationalization and a highly favorable product mix. They achieved a robust 22% gross margin, and crucially, total revenues rose 11% year over year, largely due to record shipments of their Antora computing platforms. This is real volume growth meeting efficiency. This isn't manufactured profit. It's a strategic pivot toward an integrated hardware plus services model.
That's an interesting point about the pivot. I'll give you that. Especially that 68% growth in high-margin service revenue, compensating for the volatile software license revenue. But I would frame it very differently. That $0.9 million profit is accounting profit. It's based on accruals, and it's masking a severe, almost immediate underlying liquidity problem.
Why do you see that profit as being so divorced from their actual cash position?
Because their balance sheet, it just screams distress. Look at the current ratio, that's current assets divided by current liabilities, which was 0.53 as of September 30th. This is technically a serious distress signal. It means that eCarx has nearly twice as many short-term financial obligations due in the next year as they have liquid assets or cash on hand, which was only about $50.4 million. They were in essence forced to go out and get high-cost, aggressive debt.
That structural fear you're describing is real, I get that. But let's circle back to the operational reality. They also have a significant operational advantage that generates future value, which the market seems to be completely ignoring. They've reduced the time required for Google Automotive Services, or GAS certification, from 18 months down to just 8 months. That massive time-to-market advantage is essential for securing new global OEM contracts outside of the Geely ecosystem. The Polestar 4 and Volvo EX30 adoptions are the proof points of this agility.
Operational agility doesn't matter if your capital structure is designed to choke off any upside. The market isn't ignoring fundamentals. It is reacting rationally to the structural dilution signals sent by that October 2025 $150 million convertible note issued to ATW Partners. The initial conversion price of $2.59, that acts as an artificial iron ceiling. Any meaningful rally is immediately capped by institutional arbitrage selling right at that price.
Okay, that's where we need clarity. Why is this debt so uniquely toxic compared to standard financing, just aside from the high yield?
Because of the alternate conversion clause. Let me just walk through the mechanic here. If the stock performs poorly, ATW can convert their debt into shares at a massive discount, specifically 85% of the lowest 10-day volume weighted average price, or VWAP, subject to a 47-cent floor.
So wait, if the stock starts dropping, the lender can convert at a constantly moving, even lower price and just get more and more shares?
Exactly. It creates this powerful, perverse incentive for arbitrageurs and sophisticated short sellers to actively suppress the stock price. If they can keep the stock hovering down near the floor, they maximize the number of shares they receive upon conversion, and then often sell those newly acquired shares immediately. This is the very definition of a death spiral or toxic convertible debt. The price action you're seeing is the market rationally pricing in the future dilution that's caused by this self-reinforcing structure.
I concede that the structure presents severe headwinds. Let's move to the quality of that Q3 profit, which you challenged. I maintain the 37% cut in selling, general, and administrative expenses shows operational maturity and a leaner structure. But let's address your skepticism around that massive 46% year-over-year cut in research and development.
Starving R&D, dropping it from $48 million down to $25.9 million, is in my view the equivalent of mortgaging future growth for immediate P&L satisfaction. In this high-stakes, rapidly evolving auto tech sector, if eCarx isn't investing heavily today, they risk being completely outcompeted by capitalized giants like Qualcomm and NVIDIA in that critical 2027-2028 product cycle. The market recognizes this lag.
I see why you think that. I do. But I would frame the R&D cut as strategic resource prioritization, not starvation. eCarx isn't a pure R&D lab. They're moving toward integrated solutions. The cost reduction, I think, reflects the successful completion of the heavy lifting and high capital expenditure required for their current platform generation, Antora and Pikes. They achieved profitability because they shifted from expensive initial development to more efficient scaling and integration. The discipline shown in the SG&A cut just confirms this move toward a more industrial post-SPAC mindset.
But the systemic skepticism against de-SPAC entities is reinforced precisely by this behavior. The market views any R&D starvation in a growth-focused tech company as a sign of financial duress. They look at the 0.53 current ratio and the R&D cuts, and the narrative they construct is, this company is cutting into bone just to report a temporary profit.
Let's talk more about that mechanical selling pressure then. You mentioned the extraordinary dark pool activity. I acknowledge the high off-exchange short volume, 41.95%, is far outside the norm. But I have to ask, is this all toxic hedging? My theory is that institutional investors are basket trading ECX with other struggling peers, like say Luminar,
in the distressed auto tech sector. It's sector contamination. The positive news is negated by this sector-wide malaise.
That's a compelling argument regarding correlation, but the evidence here points toward a much more explicit self-serving mechanism, convertible arbitrage. The high off-exchange short volume is not just directional betting. It is institutional hedging that is directly tied to the ATW note.
Could you break down that hedging process for us, maybe step by step, for the audience who might not trade institutional debt?
Absolutely. It's a closed-loop system. When a fund like ATW purchases the $150 million convertible note, they are long the debt. To protect themselves from a sudden rally that might harm their conversion math, they simultaneously short a calculated amount of the common stock. And they use alternative trading systems, DART pools, for these massive short sales.
And why use dark pools instead of the public exchange?
To avoid crushing the stock price immediately. I mean, if they dumped 40% of the daily volume onto the public market, they would trigger a massive crash and just ruin their own trade economics. By executing in dark pools, they create this mechanical, persistent selling pressure that keeps a constant lid on the stock price without causing volatile crashes. It's a guaranteed distribution mechanism that ensures price stability, but only below the conversion threshold.
That really clarifies the implication of that massive FTD spike on November 4th.
Precisely. The 1.2 million shares that failed to deliver right around the earnings date is the footprint of this mechanism. It suggests massive dislocation or, frankly, highly aggressive naked shorting as these arbitrageurs rushed to set up or adjust their initial hedge positions following the earnings release. This structural pressure is actively suppressing stable, fundamental price discovery.
Okay, let's pivot to the final point, management signals. How do we reconcile the company simultaneously needing $150 million in high-cost convertible debt while maintaining a $20 million share repurchase authorization from December 2024? That is a fundamental contradiction in capital allocation.
I agree completely. Given the severe liquidity crunch, that $50 million cash position and the sub-1 current ratio, the buyback authorization appears entirely performative. It's symbolic. It sends two conflicting narratives to the market. We are distressed and need aggressive debt. And at the same time, our stock is undervalued and we should buy it back. The market gets confused, and confusion rarely translates to a rally.
I see the inherent risk, but I would maintain it's a critical signaling mechanism. It's directed at the long-term retail investor base, those who believe in the Geely moat and ECRX's operational strength. They require reassurance that management believes the stock is undervalued relative to the new Q3 financials. It's an act of conviction. I mean, the profitability milestone is built on hard metrics, specifically the 667,000 computing units shipped in Q3. The buyback, even if not fully executed, is a necessary element of investor relations in this highly skeptical environment.
But in this climate, conviction is expensive. Utilizing precious limited cash to execute a buyback while you're simultaneously taking on toxic dilutive debt only exacerbates the structural concerns. The balance sheet risk is paramount right now.
As we wrap up, I still maintain that the operational success of ECX achieving profitability, executing that strategic pivot to integrated services, and securing that crucial time-to-market advantage with gas certification, it all provides a strong, quantifiable fundamental floor. The structural challenges we've discussed are technical constraints that management must navigate, sure, but they are not indicators of a failing business. The market is simply slow to realize the pivot has happened.
And I'll reaffirm that until the overhang of that highly unfavorable convertible note is either paid down entirely or the stock clears that $2.59 hurdle on massive sustained volume, the toxic debt structure will absolutely cap all upside. The market mechanics, which are driven by institutional arbitrage, are currently far more powerful than the company's P&L statement. ECX is a fundamental battleground, and the structural bears, well, they're winning the war right now.
So this discussion really highlights the profound paradox of ECXU. You have a $0.9 million net profit standing in stark opposition to a mechanism that's designed to create significant structural dilution risk. The critical importance of that $2.59 conversion price ceiling and the omnipresent role of dark pool institutional hedging are the key variables that are going to determine the stock's direction moving forward.
The source material really forces the listener to weigh which truth is more powerful, the company's internal operational turnaround or the external financial handcuffs that have been placed upon it.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.